While importing economies, including Turkey, India, and Thailand, are liquidating dollar reserves to fund elevated energy costs following the closure of the Strait of Hormuz. Central banks are simultaneously intervening in currency markets to limit depreciation and contain the local currency fuel price inflation. And the Treasury yields have risen sharply as the foreign official selling compounds existing inflation concerns, raising borrowing costs across the economy. With this context, let's start with the reserve liquidation mechanics. The New York Federal Reserve serves as the primary custodian for the foreign official institutions holding of US government securities. This infrastructure, which includes central banks, sovereign wealth funds, and the international organizations, has historically provided a stable base for demand for the Treasury issuance. The custodial holdings function as real-time barometer of global dollar reserve management, with changes reflecting both portfolio decisions as well as foreign exchange intervention activity. The scale of the current drawdown is important even in historical context. While the Treasury market has roughly tripled in size since 2012, the foreign official holdings at Fed have now returned to levels last seen that particular year. This divergence underscores a structural shift in the composition of Treasury demand, with foreign private investors and domestic institutions absorbing an increasing share of issuance as official sector participation has waned. And this brings us to the energy shock transmission channels. The closure of the Strait of Hormuz has triggered a surge in the global energy prices, creating immediate balance of payments pressure for oil importing economies. Countries must now source larger dollar quantities to pay for the same volume of oil imports, depleting foreign exchange reserves and forcing difficult fiscal choices between subsidizing domestic fuel prices or allowing household energy costs to increase. Turkey's response illustrates the magnitude of this particular pressure. The central bank has liquidated 22 billion in foreign government securities since the conflict began, and a substantial portion of which is likely consisted of US treasuries. India and Thailand have similarly drawn down foreign exchange reserves, though the precise composition between the treasury holdings and the dollar deposits remains unclear from the available data. There is also a currency defense dynamics that is involved out here. Beyond the funding of oil imports, central banks face secondary pressure to defend their currencies against dollar strength. Currency depreciation creates a self-reinforcing inflationary spiral. Weaker local currencies increase the cost of dollar-denominated oil, which further pressures current account balances and places additional downward pressure on the exchange rates. Many central banks have opted to intervene in the foreign exchange markets to limit this depreciation, selling dollars and purchasing local currency. This intervention requires drawing down on the dollar reserves typically held in liquid instruments such as treasuries.